multiples. So describe the general approach to comparable multiples-based precedent transaction analysis-based valuation. So we talked about that last time, right? It's when you basically use guideline companies, whether just that are currently trading right now, they're called trading multiples, their relative valuations to predict the valuation of your own firm, or they're using precedent transactions, actual past company sales to predict what you may be worth, right? So we talked about that. What are the most important limitations comparable precedent transaction analysis? What could drive bias in those valuations? Well, the fact that the market itself, it's a market-based valuation, it's much more sensitive to the market kind of whims. It might be market being overvalued or undervalued and so on. What is the asset bubble? How could it affect reasonableness of comparable and precedent transaction valuation? So if you're in a bubble-like situation, when asset bubble is a temporary condition when market is valued too high relative to fundamentals, and which may drive you to overvalue the firm, right? If the problem is you don't know that you're in a bubble until the bubble bursts, so then there is a philosophical debate where you truly in the bubble, then, right? So that's kind of like an eternal debate between two different schools in financial economics. I don't want to get into that. But the bubble could be defined as when a relative market P multiple, right? That is the overall valuation of the market relative to its aggregate earnings becomes historically unreasonably high, right? So it's kind of like in the eyes of the beholder. And it's not viewed as sustainable. Can you say for sure valuation multiple is reasonable? Why it might be difficult to do ex ante? No, for sure you cannot tell, right? Because again, well, it may be reasonable based on so that's like, yeah, but let's say market crashes. Well, with the benefit of hindsight, the market was overvalued. But that's really not a fair thing to say, because you need to say, was it valued correctly at the time, given the information that was known? Right, so that's kind of this eternal debate. What are the typical challenges to coming up with appropriate less biased valuation multiples? Well, lack of comparable companies would be one. Lack of sufficient number of precedent transactions would be the other, right? Well, there's not that many mergers in the industry. Well, there's nothing to compare to. There have been, or very unique business model, high level of diversification. If the company is in 10 different businesses, well, who are its true comparables then? Right? Who is a true comparable of Amazon? Well, Walmart maybe. What is it called? Alibaba, but that's a couple, right? They're not exactly the same. And Walmart is not in the web services business, as far as I know. Walmart is more comparable to Target, right? So this is a kind of self-evident. Describe some of the approaches that can be used to identify company peers with comparable base valuations. How can we try to minimize the bias and noise in doing so? Well, we talked about that. First step for a public company is its own 10K. And then you kind of try to narrow the field, right? You say, okay, size-wise, growth-wise, risk-wise, customer-wise, and markets-wise, where are more similar versus less similar? And you start with a broader, Rosenbaum will talk about the universe of public companies. You try to go from 10 down to 3 or 4, something like that, right? To give you kind of a more narrow, reasonable range. Valuation range is, on the basis of the multiples that comparables that you have, try to establish the range of value, right? Like if you use, high versus low, and try to get it narrowing.
Yeah, actually, I had a question regarding this.
Go ahead.
Like 7, it's based on the exhibit in the book. It's on where is the range, the valuation range used is in page 52.
Okay.
52 and 53.
Okay, yeah, so,
52
Yeah.
and page 16. So this range, like the list of comparable companies are on like page 16.
Page 16 or page 52?
No, I mean, the comparables, that the example on the exhibit, like the,
Exhibit 1.2.
yeah, exhibit.
Value
This is the list of comparable companies.
Yeah.
And on page 52 and 53, it's like, it's shown how we like do valuation implied by different multiples.
Yeah.
So the range over here, the multiple range, I try to locate like on page 16, try to see on page 16 and try to understand like how this range was, what do you say, like established. The range that.
Well, I mean, maybe you and I could walk through this separately, but the bottom line is, if you look at exhibit 1.2, it gives you different multiples, right? So let's say it gives you LTM sales, LTM to EBITDA, and so on. And it's different multiples, and different multiples will yield you different values, right? And that creates sort of a distribution of values on the basis 2 or 3, and that gives you this. You start with a wider range based on a greater variety of multiples, and then using your judgment, you want to narrow it down to something more reasonable.
You mean like one on the exhibit 1.3?
Yes.
Okay, we narrow it by our own judgment,
Yes.
unbiased.
Yeah, you try to kind of say, okay, well, based on what I know about the firm, and this is what it's kind of like using your judgment to reduce relative uncertainty, right? And the uncertainty is the width of the range, right? Come up with something. But you're right, that's basically a judgment-based exercise.
So I think it requires like trial and error as well. Like on
Yeah,
some
it's like,
kind
yeah.
of range, we get like reasonable.
Yeah, you say, okay, well, yeah, you say, okay, what's reasonable to me? Yeah. Okay. All right. All right, so what are the commonly used multiples? Well, PE ratio is probably the most commonly used, but Rosenbaum and Pearl talk about enterprise-based multiples as being preferred because they ignore capital structure problems. So enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT. Those are the ones that kind of industry prefers. Describe some factors can be used to establish universal comparables. What are some of the ones that we should start with? So we talked about it already, right? What are the competitors? Similar size, of similar growth profile, of similar industry profile, and so on. Describe adjustments such as LTM and non-recurring items. So LTM stands for the last 12 months. Yes, thank you. And that has to do with annualizing your data, right? So, typically the financial statement data is as of, let's say, 12/31, right, that you have. But if the merger happens in July, affected into what? Through July, rather than just use income from months, right? So what you do is you shift the data forward. You take the last, so to just draw a picture here. And so suppose you were trying to value company on July 1st, 2023, right? The last annual filing will be 12/31/2022. So this is 6 months. This covers 12/31 period from 12/31/21 to 12, this is 12 months, right? So how do you make it last 12 months? You take this period, so then let's say net income as of 12/31, or let's say not income, let's say take sales. 12, as of 12/31/2022, you add to it, this is 12 months, remember? You add sales for first and second quarter of 2023, right? But what do you need to subtract?
Previous.
The previous 6 months. As sales for first and second quarter of 2022. That will effectively shift the data 6 months forward. That's what it is. It gives us more appropriate time matching, right? For the multiples purposes. Okay? You try to have your multiples measured as close to possible your metric. If this is the date you're valuing, if you're valuing over here, you want to try to value as of, use the metric as of the latest, closest financial statement date. That's the idea. All right, the other idea that it's asking about is non-recurring items. So, and Krugman talks about it. So oftentimes companies will have like one-time transactions. So they may have had like a restructuring, right? Where they have to take costs because they have to fire a bunch of people. Or they had like they sold a plant. So when you do this kind of an analysis, you want to adjust for, you want to back out any one-time items. You want to only look at what's called normalized sales or normalized income. The term that we use in accounting research is called persistent, sales that will recur. So if there is a component of sales that was unique to that particular year, or is a component of net income that was unique to that particular year, you want to exclude that, right? The term that Krugman uses is normalization. You want to normalize the earnings. You only truly care about component of financial statements that will be recurring into the future. They're not unique to this period. Okay. The other point that Rosenbaum and Kroll makes that once you exclude them, you need to make sure that you have any tax effects, right? If it was, let's say, about pre-tax item, you need to make sure you gross when you exclude it, you also gross it up by the tax effect. You have to multiply by 1 minus the tax rate and divide it. I'm sorry. Okay, to calculate the net income impact. Let's see. Sorry, if you exclude it, you multiply 1 minus the tax rate. What are the factors? So what is the basic difference? Sorry, where are we here? What is the fairness opinion? How can it be helpful in identifying comparables? Well, fairness opinions is something, anytime there is a merger and acquisition, investment bankers have to essentially write a letter justifying the selling price. And that for public companies, it has to be included in the proxy statement. And that's a great source, that basically they have to describe how they value for the position. And they have to talk about multiples they use, the growth rates they use, the discount rates they use. So that's in and of itself, those assumptions are a great source of information to understand what are the typical assumptions, so how you can use in your own valuations. Except I told you, my colleague and his colleague, my author and their colleagues analyzed a bunch of those, and they found they tend to be pretty optimistic most of the time. That's the problem, right? Because that reflects the investment banker incentives. And I have an example of a fairness opinion you can look at that I posted. What does the Krugman say about comparable companies' approach in private valuation context? What sort of adjustments, caveats he suggests need to be made for public companies' valuations? So again, first of all, it's much harder potentially to find similar transactions. That's the issue. So oftentimes, public companies are your first starting point. You need to look for similar public companies. Just greater uncertainty, sort of like you have to be much more careful with the choices. What's the basic difference between comparable companies analysis and precedent transaction analysis? Comparable companies analysis uses current valuations of companies that are being traded right now, right? Precedent transactions is past merger and acquisition data. What is the potential basic problems with precedent transaction analysis that will limit their use? Well, number one, not enough past transactions would be number one, right? And again, also lack of similarity, right? Because it's kind of like finding the exact same house that was sold in a reasonably recent period of time, right? It's not particularly relevant. It was sold 10 years ago. What factors should you consider in choosing the most relevant precedent transactions for evaluation? Number one, similarity of sale to your company, right? The company being sold, and recency. Those are the two biggest factors, I would say. And also the reason why, right? Is the sale for control purposes or not? Because control, if you're seeking to buy control and you're trying not to value for control purposes, the valuation that precedent transaction will give you might produce more bias, right? So you need to be careful for understand the reasons for why the precedent transaction, are they looking to buy control? It is for synergetic reasons and so on, right? So you need to make sure you compare apples to apples. All right, so this is kind of the review questions for